Most parents want to ensure that their kids receive the inheritance that they intend without the government taking a portion. And in many cases, that money has already been taxed to death. So the government coming in and taking even more doesn't really seem all that fair.
Life ain't fair, man.
That said, in 1986, the government created the Kiddie Tax to target unearned income from children. This closed a loophole where wealthy parents would use their kids for tax benefits. Go figure, the government always wants their money. So if you're currently dealing with kiddie taxes or are curious about it, I sat down with my AI assistant Tiara to tell you everything that you need to know about the kiddie tax. And this is how that conversation went. Dear Tiara, I'm looking to gift my kids some unearned income and want to do it in the best way possible. Can you explain everything about the kiddie tax so I know how to do this properly?
Of course. First, let's touch on who this applies to. Age is a big factor. The tax applies to children under 18 and full-time students aged 18 to 23 years old. But here's the catch. It only applies if the child's unearned income is above a certain threshold. For 2024, that magic number is $2,500. Keep in mind, this number can change from year to year. There's also a parent factor. The kiddie tax kicks in if the child can be claimed as a dependent on their parent's tax return. Even if the parents choose not to claim the child, if they could have, the kiddie tax still applies.
Great insights here. Next, I had asked Tiara if she could give me a simple example so I could see when it would apply.
Sure. I can give you 2 example scenarios. Alex is a 20-year-old college student. Alex's grandparents left her some stocks that earn about $3,000 a year in dividends. Even though Alex is over 18, she's still a full-time student under 24, and that dividend income is over the threshold. So, Alex would be subject to the kiddie tax on that extra $500 above the $2,500 limit. On the flip side, let's say Alex's 17-year-old brother Sam mows lawns all summer and makes $4,000. That's earned income from actual work, so the kiddie tax doesn't apply to Sam's lawn mowing money. It only applies to unearned income, usually in the form of dividends or interest.
Perfect example, and I really like how simple it was. And shout out to Sam for working his butt off the entire summer.
Gotta make a living, man.
Next, I wanted Tiara to explain exactly how this actually works and give us some numbers so you know exactly what to expect.
The kiddie tax kicks in when a child's unearned income, think dividends, interest, capital gains, exceeds a certain amount. For 2024, that magic number is $2,500. Here's how it plays out. The first $1,250 of unearned income is tax-free. It's like a freebie from Uncle Sam. The next $1,250 is taxed at the child's tax rate. This is usually pretty low, sometimes even 0% if the kid doesn't have much other income. Any unearned income above $2,500 is where the kiddie tax comes into play. This portion gets taxed at the parent's marginal tax rate, which is typically much higher.
So this is a clear example of how it works, but I wanted another example so you can actually see the kiddie tax in action. And here's what Tiara came up with.
Zoe is a 16-year-old with some savvy investments that earned her $3,500 in dividends this year. The first $1,250 is tax-free. The next $1,250 is taxed at Zoe's rate. Let's say it's 10%. The remaining $1,000 is subject to the kiddie tax. If Zoe's parents are in the 24% tax bracket, this $1,000 will be taxed at 24%. So, Zoe's tax bill would look something like this. $0 on the first $1,250, $125 on the next $1,250, Zoe's 10% tax rate of $1,250. $240 on the last $1,000, Zoe's parents' 24% tax rate of $1,000. This would make the total tax bill $365. Without the kiddie tax, if all of Zoe's income was taxed at her 10% rate, she'd only owe $225. That's the kiddie tax in action.
Now remember, these numbers can change year to year, so always make sure that you check the current rates. And keep in mind, this is a very simplified example. Real life situations, typically they can get a lot more murky. There's a lot more details, a lot more assets involved. And if you're dealing with that type of situation, it's probably best that you speak to a professional. Next, Tiara wanted to clearly explain what unearned income is affected by this, and I think that it clears things up a little bit.
The Kiddie Tax specifically targets what's called unearned income. This is money that comes from investments rather than from work. Here's what income it impacts. 1. Dividends. This is the cash that companies pay out to their shareholders. If your kid owns stocks that pay dividends, that's unearned income. 2. Interest. Think about the money a savings account earns. That's interest, and it counts as unearned income. 3. Capital gains. If you sell an investment for more than you paid for it, that profit is a capital gain. This includes things like selling stocks, bonds, or even collectibles. 4. Rental income. If your child somehow owns a property that's being rented out, that rental income is unearned. 5. Certain trust distributions. Some types of trust fund distributions can also fall under the Kiddie Tax rules.
Now, these are good examples, but because we're trying our best to keep the government's hands out of our pockets, I asked Tiara what investments someone should consider in order to avoid these taxes, and here's what she said.
If you're a parent looking to invest for your kids, or a young investor yourself, here are some smart moves that might help you sidestep the Kiddie Tax: U.S. savings bonds. These are like the slow and steady turtle of the investment world. The cool thing about certain savings bonds, like Series EE or I bonds, is that you can choose to defer reporting the interest until the bond is cashed in. So, if you wait until your kid is no longer subject to the Kiddie Tax to cash them in, you might avoid it altogether.
So this is a good example, but keep in mind that even if they avoid the Kiddie Tax here, that they will have to pay taxes when they cash their bond anyway. The key difference is that the kids would have to pay their own tax rate as opposed to the potentially higher tax rate of their parents through the Kiddie Tax.
Municipal bonds. The interest from these bonds is generally free from federal taxes, and sometimes even state taxes if you buy bonds from your home state.
A good option for those not looking to be impacted by the Kiddie taxes when used in conjunction with some other ideas mentioned.
Growth stocks. Think of these as the plant a seed and watch it grow approach. Growth stocks focus more on increasing in value over time rather than paying out regular dividends. The idea is to hold on to them until your child is older and no longer subject to the Kiddie Tax.
Now, for growth stocks, assuming that they hold them for a long time, it's more than likely that they're going to be taxed at the long-term capital gain rate, right? And that can be as low as 0% or as high as 20%. It really depends how long you actually held them and what your taxable rate is on that given year.
529 college savings plans. These are like a tax-free piggy bank for education expenses. The money grows tax-free, and as long as you use it for qualified education expenses, you won't owe taxes when you withdraw it.
Now, I've made an entire video all about these types of accounts, and at the end of this video, I'll provide a link to that if you're interested.
Roth IRAs for kids. If your child has earned income, remember, that's money from actual work, you can open a Roth IRA for them. The contributions can be withdrawn tax-free at any time, and the earnings grow tax-free too.
Now, if you can get your kids to contribute through their first job or, graduation money, anything like that, and they actually start to save, this is a great way to do it, especially if you're starting early.
Remember, the goal here isn't to avoid investing for your kids. It's about being smart with how you do it. By focusing on investments that either defer income or generate tax-free income, you can help your kids build wealth while keeping the tax man at bay. As always, these strategies can get complex, so it's a good idea to chat with a financial advisor or tax professional to figure out the best approach for your family. Every situation is unique, and what works for one family might not be the best for another.
I think the key here, as mentioned by Tiara, is not to avoid investing. The idea and what you want to stick to is invest in a way that keeps the government's hands away from your child's money. Now, I mentioned earlier that I had a video all about 529 plans. So if you're interested in that, you can click right here, or if that's not for you, go ahead and click right here for my most recent video. And as always, if you enjoyed the video, please make sure to give it a like so YouTube shares it with others, and make sure that you subscribe to unlock financial success one AI chat at a time. Thanks for watching.